The trends from the last month or so have been continuing. So, the adage as you come into May, sell in May and go away is one that probably wasn't the best strategy this time around. Markets are up in the order of 4 to 5%. If you're looking at Aussie market, around 4%, which is a pretty robust month, led by some of the financials and some of the technology businesses. And similar, or if not stronger, results from overseas markets. So certainly US and other parts of the world, developed markets were a little bit stronger than the domestic market. What's driving, I suppose, is probably a little bit of clarity around the tariffs and the pause on the tariffs that were announced in the US and what it actually means for markets. So I think many are probably trying to understand how they can negotiate their way through and whether there will actually be the level of tariffs come into effect that were announced in early April. And I think most probably are suggesting that it's unlikely to be at the level that was proposed. 10% seems to be the number that's generally being talked about. Still, that will have an impact, so that will have an inflationary potential impact. It may have a margin impact for companies, so whether they are able to pass that on, or if they need to do anything, or in terms of how they address that increase in tax. So those, I suppose, with a bit of clarity around the pause, the delay, the negotiation, and a way forward, have probably all been seen as positives for the market, and the market's returned to a pretty strong phase of up movement in the last sort of 5 or 6 weeks. Markets have been volatile, and if you tried to adjust to all the Trump announcements and recoveries or changes in his perspective and the policy positions that they've put out there, you'd be all over the place in terms of what you're doing in your portfolios. We take a long-term view. Our clients have got a long-term perspective on and long-term requirements for what they need to do with their money, and we try to align our approach and philosophy with what they're trying to achieve. And clearly, different clients will have different objectives over short, medium, long-term horizons. And we try to obviously look at different asset classes and the outlooks for those different asset classes and align with those sort of timeframes. Partway through some of the reporting seasons around the world. We'll come to Australia shortly, but specifically think of some of the largest businesses and the largest businesses that are growing very strongly. So NVIDIA reported earnings. It's a quarterly update, which is probably a little bit too frequent for a long-term investor. Nonetheless, I think it was about a 12% revenue growth number. So these are big numbers on big numbers. So hence the reason why they have been performing very strongly. If you look at medium to long-term bond yields, they were relatively flat month to month, so start to end of the month. We've been talking for a while now. They have been volatile, so they're still volatile within the month, and that's bond investors trying to assess again what the right rate, what the right yield is for long-term investments, and what sort of margin of safety investors need for those sort of long-term investments. If we look at bond yields, again, in the Aussie sense, there wasn't too much move from month to month, end of month to the start of this month. Cash rate, though, was adjusted. So the RBA met mid-month and reduced the cash rate to 3.85 or 3.85%. Good news, for borrowers, and good news for those looking for a bit of a leg up in terms of cost of borrowing, which I think sort of flowed through to some of the property prices. If we look at currency markets, I think there's been a little bit of a rotation and probably a little bit out of US equities as well, around that US exceptionalism trade, that people were assuming that the US was the safest and best place to put investment money, whether it was equities or fixed interest securities, and that obviously flows into currency values as well. So the more demand there is, the higher the price would be, or the higher the currency would be. As we've seen a little bit of a rotation in that US exceptionalism trade, we're starting to see some strength in non-US currencies, so weakness in the US dollar. And so Australian currency has been a small beneficiary in that. And we're at levels in the sort of mid 60s at the moment on the Aussie dollar. It was a little higher than that about 12 months ago, but it's at the highest point now that it has been for this calendar year. The Fed meets mid-month, as we mentioned, so I don't look like there'd be any change in the cash rate there. We'll probably continue to have a little bit of volatility in markets with company announcements here. Clearly there's a little bit more reporting period updates to come through, largely in the States, heading into the end of the financial year. So once we get later in this month, it'll be a bit of a blackout period for companies, so there probably shouldn't be too many more surprises for Australian investors. But otherwise, it's general data points that will come through. So there's GDP announcements that will come through. There'll be inflation announcements that come through. We'll continue to watch them and monitor them for any sort of trend change. But otherwise, philosophically, I don't think we'll be looking to make too many changes.